March 30th. Hope this video finds you and yours well. If you're following me, you may have seen some of the stuff behind me here slowly getting more in disarray. Our children are slowly dismantling our home brick by brick, but the QT is priceless, so we are enjoying and making the best of it. This topic, cap rate. So a few investors have reached out. As often I do, I confused a few people with some of my cap rate references to the unleveraged yield that we talked about in a March 19th video. So I thought I'd do a quick little response to that just to clarify some things. One investor, pointed out a great definition of cap rate, which is simply, the risk that people are willing to take, and it's determined, the cap rate itself determined by the asset class, by the market, right? Which is all true. What I was referring to in the video is another way of looking at cap rate, which is quite simply, it is also equal to the unleveraged yield on an income stream based on the price you pay for an asset. So really quick and dirty example here. You buy a commercial asset, and after all expenses are paid, your NOI, right, is $100,000. If I want a 10% yield, I can pay a 10 cap for that property. I can pay $1 million, right? $100,000 a year into $1 million investment is a 10% return on my money. Or if I'm willing to take a lower return and the perceived risk is lower, I might be willing to pay a 5 cap for that property. In which case, a 5% return on a property that's generating $100,000 income stream per year means I can pay $2 million for the property. And at the end of the year, I've received $100,000 in cash flow, which is my yield, my unleveraged yield on the asset, because I haven't put any debt on it yet. And in multifamily and in other asset classes, we can get a better cash flow by using the power of leverage, using debt and equity instead of paying all cash, which, if done well, should take your yield, your return, a little bit higher. And then, of course, we add in value add, managing it for better, reducing expenses, bringing in new capital to make improvements, to generate more cash flow and increase the value of the asset. So I hope this has cleared it up. For some of you out there where I've just confused you even more on what cap rate is or its relationship as the unleveraged yield that you can expect from an asset you own in all cash, and how those two relate and how they can be equal at certain points in time. Comment below. Happy to try this again. Thanks, everybody.